Hey everyone, welcome back to the channel. If you ever opened Rocket App and felt overwhelmed, wondering which stock I should buy, or why some move fast while others barely move at all. So this series is for you now. There are 6 main types of stocks. Number 1, growth stocks. These are your rocket ships, risky but high reward. Number 2, dividend stocks. What is dividend stock? Dividend stock is companies that literally pay you to hold them. And number 3 is going to be blue chips. Your safe giant, slow but steady. And number 4 is going to be cyclical stock. They rise and fall with the economy. Number 5, defensive stock. These keep your portfolio stable when the world goes crazy. Last one is going to be speculative stock. High risk, high reward. The gambler's zone. And in this video, we are starting with the most exciting group of them all. Number 1 is going to be growth stock. Before we start talking about specific stock, I want to take a few minutes to lay down some really important foundations. Because if you are new to investing, or even if you have been in the market for a while, understanding a few basic frameworks can completely change the way you think about the business. And this is the stuff most people skip. They jump straight into, should I buy Tesla, or is Amazon cheap right now? But without the fundamentals, you are just guessing everything, and guessing is not investing. So what I want to do right now is walk you through the exact framework that I personally use whenever I analyze a company. It's so simple, but it keeps you grounded, and it makes you sure you are always looking at the bigger picture before you make any decision. So the stock analysis framework, whenever you are looking at any stock, always start from here. Number 1 is going to be macro industry context, what's happening in the economy and in that sector right now. For example, if you are analyzing a tech stock, are interest rate rising? Is the Fed tightening? Are consumers spending less? Because even the best company can struggle if the environment around it is working against them. And number 2, company overview. What does that company actually do? What gives it an edge over competitor? Is it the brand power, patents, logistic, or just being fast to market? Valuation. And valuation, is it cheap or expensive compared to peers? Look at the thing like the PE ratio, EV, EBITDA. Or if you are more advanced, maybe a DCF, which is just a discounted cash flow model. And number 4 is catalyst. What will actually move the stock price? Is there a product launch coming? An earning report, interest rate decisions. Understanding catalyst help you stay ahead of what could create momentum in the stock. And number 5 is going to be risk. And risk, what could go wrong in the risk? That's the part most people ignore. Is the company carrying too much debt? Is competition heating up? Are regulations changing? You need to think through the worst case scenario before you ever hit that buy button. So number 6 is going to be your call, and finally deciding your stance to buy, sell or hold. To really understand a company, you need to understand how companies are valued in the first place. And that's where corporate finance, accounting and cash flows come in. I'll keep this simple. The goal of every company is to maximize shareholder value. And to do that, they make 3 big types of decision. Number 1 is going to be the investment decision. Where to put their money, new product, acquisition, or research. You want to see the companies putting money where it will generate return above their cost of capital. Number 2 is going to be the financing decision. How to fund those investments through debt or equity. Debt is cheaper because it's tax deductible, but it adds risk. Equity is safer, but it difficult ownership. And how about the dividend decision? Number 3, how much profit to give back to shareholders? Some companies reinvest everything. It means like growth stocks. Other return cash through dividends or buybacks. This company generates returns above a cost of capital, which means it's actually creating real value of the shareholders. That's something you will hear professional investors say all the time. And that cost of capital, or WACC, is just the minimum return a company needs to beat for a project to make sense. If they earn more than that, they're growing values. If they earn less, they are destroying it. And here you need to understand, there are three main financial statements you need to understand. Number one is like income statement, or profit and loss, you can say. Shows how much the company earned. Revenue minus expenses give you net income. And number two is going to be balance sheet. It shows you what the company's on versus what it owes. Asset versus liabilities. And number three is like a cash flow statement. And it shows where the real money is going in and out. The most important part of the last one is free cash flow. That's the cash the company has left after running its operation and making investments. So free cash flow is what pays dividend, funds buyback, pays off debt. When I read financial, I'm looking for alignment between net income and cash flows. If a company reports great profit but poor cash flow, that's a red flag. And a professional investor would say something like this: earning quality is high since free cash flow matches reported net income. And that's what you want to find. A few quick ratio here I use all the time. Debt to equity shows leverage too high, and that could be a problem. And current ratio shows liquidity. Can they pay short-term bills easily? ROE, return or equity. ROE shows how efficiently the company turns shareholders' money into profit. And for the margins, gross margin, profit after production cost. Operating margin is going to be profit after operation expenses. What about the net margin, the final bottom line? These are the things that tell you how healthy a business actually is. So if you are new to investment, don't rush into picking stocks. Start by learning these foundations: how to read statements, how to analyze industries, and how to think about valuation and the risk. Once you understand this framework, every stock you look at will start to make sense to you. You won't just ask, should I buy? Or you will ask, why does this company deserve my money? So starting with the most exciting group of them all, it's going to be a growth stocks. And in today's video, we are specifically going to focus on three of the biggest names that comes up almost every time someone says the word growth, like Amazon, Shopify, and Tesla. These are what I like to call the rocket ships of the market. They can soar incredibly high, but they can also be volatile. So if you are thinking about investing in these type of the companies, you really need to understand not only their business model, but also how to evaluate. So before we dive into each companies, let's just clarify what growth stock actually is. A growth stock is typically a company that's expected to grow its revenue and earning a much faster rate than the overall market. These companies are pouring most of their profit back into the business, whether that's for research and development, marketing, or expansion, or hiring. And that's also why when you look at their financial, you will often see low or even negative profits, but very high revenue growth. And that's normal for growth stock. What makes growth investing tricky is that it requires a lot of passion and a lot of discipline. Because you are not investing in what the company is today. You are investing in what it could become 5 or 10 years down the road. And the biggest challenge most investors face is separating hype from genuine potential. So what I like to do is run each of these companies through a few filters. We are going to use these 4 filters today to look at Amazon, Shopify, and Tesla. Let's go to Amazon. the growth veteran, we call it, probably the most famous growth stock of all time. Amazon's story is quite fascinating because it shows how long it can take for a growth company to become profitable. For nearly 2 decades, Amazon was mocked for being a company that sold books online and made no money. But what they were actually doing was quietly building one of the most powerful infrastructures in the world. From e-commerce to cloud computing to logistics, today Amazon growth has slowed down compared to the early 2000s, but it's still incredible strong. In 2024, they reported over 570 billion in annual revenue, which is mind-blowing. When you think about where they started, now when I look at Amazon as a growth stock, I focus on a few things, like Amazon Web Service. This is their cloud computing division, and it's the real profit engine behind the company. AWS alone generates more than half of Amazon total operating income. And advertising, Amazon has quietly become the third largest digital ad company in the world. Behind Google and Meta, it's the fastest growing high margin segment that not enough investor talks about. Amazon is turning its delivery network into a service that other business can use, which could be the next massive revenue stream. But here is the thing, growth investors often make the mistake of chasing past performance. So what I do is I ask myself, what's Amazon's next phase of the growth? Maybe it's AI-driven logistics. Maybe it's deeper integration with healthcare and grocery. Or maybe it's something we don't even see yet. But as always, I try to think, what could go wrong? And for Amazon, regulatory risk is huge. They have been under antitrust scrutiny, and increasing cost for logistics and labor could show margins. So overall, Amazon is what I call a mature grown stock. It's still growing, but at a more comfortable, controlled pace. So let's get to the third one, Shopify. Shopify, like the digital backbone. And this is one that I personally think is one of the most misunderstood companies in the market right now. If Amazon is the mall, Shopify is the infrastructure behind all the small stores inside the mall. They don't compete with Amazon directly. Instead, they empower millions of entrepreneurs and small businesses to build their own online stores, handling payments and ship product globally. The reason Shopify fits the growth category so perfectly is because of how fast their ecosystem has expanded. The revenue has grown from just 200 million in 2015 to over 7 billion in 2024, which is huge. And they continue to reinvest heavily into new tools for merchants. From AI integration to logistic partnerships, when I analyze Shopify, I look at gross merchandise volume, GMV. That's the total value of goods sold through their platform. It tells me how active their merchant basically really is. So if we talk about merchant solution versus subscription revenue, Shopify makes money into two main ways, through monthly subscription and through fees on transactions. The fact that their merchant solution have overtaken subscription revenue, so cash flow in Shopify negative for years, but recently start showing positive free cash flow, which means they are entering a more sustainable. The risk with Shopify, though, is competition. You have Wix, Squarespace, and even Amazon trying to make it easier for sellers to go independent. So Shopify's moat really depends on the quality of their ecosystem and integration. Things like payment tools, inventory management, and analytics. I always remind myself here in growth investment, the best companies aren't always the ones with the flash heights numbers. They are the one building ecosystem that are hard to replicate. Shopify is doing exactly that. And number 4 is going to be Tesla, the wild card. Now, let's talk about Tesla, which is probably the most controversial growth stock of the past decade. Some people call it a car company, others call it a tech company, and Elon Musk calls it an energy company. And honestly, it's kind of all three. Tesla growth story is built on one idea: accelerating the world transition to sustainable energy. And whether you like Musk or not, you have to admit that the company has executed on a massive scale. From selling just 50,000 cars a year back in 2015 to over 1.8 million vehicles delivered in 2024. Tesla's scale-up has been extraordinary. But what makes Tesla fascinating from an investment standpoint is its margin profile. They make more money per car than almost any other automaker, largely because of the software and engineer credit. When I analyze Tesla, here is what I focus on: gross margin. Even after price cut, they still impressive for an automaker. And on energy division, Tesla Solar and Powerwall could quietly become as big as the car business in the next decade. AI and FSD, if Tesla creates full autonomy, it could transform their business model completely. But here is where I have to slow down and remind myself: Tesla growth comes with volatility, but this stock can drop 20% in a week. So when you look at that and then double gain a month later, so it's crucial to approach it with discipline. And just like we talked about with Amazon and Shopify, I built a thesis against myself. I read the bearish arguments. Things like competition from BYD in China, regulatory challenges, or even leadership concentration. When you hold Tesla, you are not just holding a company. You are holding a vision. And with visions, the journey can be a bumpy journey. So overall, after explaining all these stocks, my final thoughts and strategies on these. For me, like growth stocks like Amazon, Shopify, and Tesla are what I call asymmetric bets. That means the downside can hurt, but the upside, if you pick correctly, can be life-changing for you. But that only works if you manage risk properly. My approach is quite simple: buy great business, understand them deeply, and hold them through volatility. That's what real growth investing is all about. So yeah, that's how I look at growth stocks, specifically Amazon, Shopify, and Tesla. I hope this video gave you a clear idea of how to think about these companies beyond the hype, and maybe help you build your own checklist for analyzing other growth stocks in the future. If you found it helpful, feel free to drop a like on this video. It really supports the channel, and let me know in the comment section which type of investing video you want to see next. Maybe we will do dividend stocks or defensive stock next week. And as always, thank you for watching this video. Take care of your finances, and I'll see you in the next video.